Welcome to the Financial Architects Podcast. It is April. Taxes are behind us. I'm Evan Makovsky, joined by Larry Steinberg. He is a partner at Financial Architects and also the Chief Investment Officer. Larry, the markets are on pins and needles about what Powell is going to do with interest rates, but is that really that important?
Oh, it's absolutely huge. There's this saying out there that says don't fight the Fed, but you don't know what direction the Fed's going. So I would say it's a very, very big deal, but it's a different deal for depending on who you are and where you are, right? For borrowers, if you're borrowing money, this is a huge headwind. This is really difficult. This is really bad. And in fact, this is going to put a lot of companies out of business. There's a lot of companies out there that are what, in essence, ghost companies, right? They've only been able to survive and operate because they've been able to borrow money for so little that they've been able to fund their ongoing operations. But now that interest costs are going to be big, that we're not awash in free money, they're going to go down. And so there's a lot of, micro cap and small cap stocks and other companies that are not going to survive higher interest rates. And really, they should be shaken out anyway, right? This is dead wood in the economy. It's not good news for people that work there, but the reality is these companies aren't capable of staying in business in any kind of economic environment that isn't free money, right? It's also really bad for banks, especially banks that didn't really position their balance sheets correctly. And the longer that it takes for a cut to happen, the worse it's going to get for them, right? Because they're sitting on long-dated treasuries paying almost nothing. And as interest rates are high, depositors are leaving. They're going to money markets or other banks that are paying higher. So they're seeing their balance sheets really just, eaten up. And the longer this goes, the next swoop of bank failures is coming, especially among regional banks, because they also have a double whammy. A lot of them are very exposed to commercial real estate and to office buildings that are going to go down. I was talking to someone recently, and they said of like the 19 key marquee buildings in downtown Los Angeles, near where I'm at, that 10 of them have been handed back to the lenders at, losses in the hundreds of millions of dollars and very large write-off to these banks. The banks are trying to extend, maturities out and, extend the interest rate for longer or do workouts. But at some point, a lot of these buildings are never going to come back, and the owners of them are better off just handing the keys back, right? And we've seen that all over the country, right? That very large marquee retail and offices have just been handed back to the lenders, and this is not good. And what these guys are begging for is an interest rate cut, but I don't think it's coming right now. And we'll talk about that a little bit later. But the other thing is, if these banks go down, I don't see them being able to bail them out like they did, First Republic and Silicon Valley Bank, right? Because first of all, there's a couple problems with that. One is that is highly inflationary. Bailing out banks is printing free money. It's no different. And that is going to be inflationary. And can they really afford to be doing anything inflationary right now? Number one. And then number two, you got to remember there's the FDIC guarantee. So when you bail out a bank, you're not bailing out everyday people. You're bailing out the super wealthy, right? The people that have more than $250,000 in the bank. It's not everyday people. And do you really want to be seeing in the middle of election of taking taxpayer money to bail out the wealthy and spread the cost to everyday people? Like this is not something that if you're in power, you want to be doing in this election cycle is helping out the rich at the cost to the poor, right? So that's, I think, a really, bad look for certain groups, right? And then for families, the higher this interest rate goes on, I mean, there's a reality is, there's auto loans, credit card debt. That's a big deal, right? If your family budget goes upside down due to inflation, then all of a sudden, you've got $1,000 on credit cards, but it's at 25%, right? Then it's 2,000, then it's 3,000. that spirals and that causes a lot of difficulties, right? And, if you need a new car and you got to go get that, it used to be that, the auto loan didn't cost you anything, it was 1%, right? Now the car, you're talking about longer term loans. People used to buy an average a 5-year car loan. Now it's a 7-year car loan, and that debt is amassing. And if the interest rate really makes a difference here. So it's easy to kind of get in a family with everything that's going on in kind of the wrong side of debt, and it to be a death spiral, right? The one area where I'm contrarian, though, is all these people that think that, that a drop in interest rates is going to be a panacea to go buy a house, right? Reality is that's just not true. All other things being equal, like if interest rates go down, you don't save any money. It probably costs you because the price of real estate just goes up, right? Because people are buying a house based on their budget, right? I can afford $2,500 a month for my mortgage, right? And then that will zero in on the size house they can build based on interest rates and the prices. But if the interest rates drop, I just see the real estate prices and the residences going up in the short term, right? That's very, very short term because there's a lot of other things going on with residential real estate. But, people shouldn't be counting on an interest rate cut that may or may not come to even do that, right? But let me then talk about by far the biggest issue here with interest rates, right? That's the government. The government at all levels is having to pay a lot more for interest. And that's going to blow up budgets at every level. That's going to blow up the federal budget. They're already talking about how the interest expense is higher than defense spending. But if we have, interest rates staying high and, 1% government bonds are having to be paid out, and then they're having to be refinanced at 5% or 4%. And in addition, you're adding, a couple trillion a year on top of that. Like that gets really, really ugly. And that's why there's actually a lot of pressure on Powell and them to cut the interest rates now, right? Because the people running government are having a very difficult time. You can't balance a budget or even come close to balancing a budget when your fixed expenses that you have to pay no matter what and your interest expense are higher than your income. That makes every other facet of government on a credit card. That's ugly and that's difficult, right? And also, if you look at where government spending is, like we're spending at deficit levels that are typically what you see in a war or a recession, right? In a war, you got to fund the war, so you're spending a lot of money there. And I'm talking about a hot war. What we're giving Ukraine and Israel is a drop in the bucket to what we would spend if we were, let's say, in World War II. And how much they spent in World War II or Korea or Vietnam. Like the spending was a huge percentage of the budget. Or in a recession. People don't get that. We're not in a recession right now, technically, right? And one thing that happens in a recession is that unemployment goes up, right? When unemployment goes up, that's a huge cost to government, right? We've got all these benefits that we have to pay, all the stuff in the, in our part of our society that catch people when they're down, that social safety net, right? We're not seeing huge outlays on unemployment right now, but we will if we get a recession and people lose their jobs. So, the higher interest rates is a huge thing, and it can't be underestimated how much of an effect it's going to have on just the government and government operations, right? But it's, higher interest rates isn't all doom and gloom, right? If you're a saver, if you're living off of, the interest on your savings account or a money market, like your income is way up, right? In fact, there's lots of people arguing that, the reason that the economy isn't doing worse is because there's this huge boon of spending that people can do because their income has gone up due to this, right? So I think that they do have a point, and it definitely boosts GDP in the short term. But, just because your savings account used to give you 1 and gives you 5, right? If you still have inflation going up and your costs are still going up, a lot of that kind of gets offset, right? So in the end, after a little while, people aren't really better off. They may have more money coming in, but at the same time, their expenses are up. So this is okay, but this isn't going to save everybody. And then let me talk about the third group, which is investors. And savers, investors are different, right? Savers are putting, stuff in treasury bonds and bank accounts and money markets. They aren't taking any, what they call, real risk, right? their values can't go down. So, but investors, they're stuck with this environment here. Like they don't want to fight the Fed, but like, okay, if I'm going to buy a bond, like I better be prepared to hold it to maturity right now, because, if I have to sell it midway, it may be like the banks had where it's worth a lot less, or it's not really that liquid, right? These higher interest rates are creating some investment opportunities, but until we get past the commercial real estate, what I think is going on there, and until we get a little bit longer on down the line, especially with housing right now, and with never being this as unaffordable right now as it is to buy versus rent as it's ever been, like something in residential is going to break at some point. So, this is kind of the morass that they're in, right? We're at higher interest rates. They want to cut, but I don't really think they can, or at least not right now.
So Larry, what is Powell going to do?
Well, here's the thing. I don't view Powell as like a Volcker or some of these other past, guys running the Fed. He's a politician, right? I think that's a big part of why we got into this problem. I think if he had his economist hat on, they never would have kept interest rates as low as they did, but he wanted to get reappointed, right? So he was going to do whatever it do to make the government look good in the short term so that he could get the job, right? And I think that if he had his brothers to do whatever he wanted without having to worry about other things, he would have already cut interest rates, even though inflation is high. But the problem is that he's worried about his legacy. And just like he was wrong on inflation being transitory, he was wrong on inflation clipping down to the 2%. He thought that what they were doing at the Fed would be enough to drop drop the economy down, to push up unemployment, to get rid of the growth. But what he forgot about, what he missed, or what he just didn't get, was that all of the massive spending from the Inflation Act and the Infrastructure Act, that trillion plus that they pumped into the economy, was going to more than offset him raising interest rates. And, because we're looking at stuff going on all around the country that is all government funded. You're hearing about $1 billion plant here and $1 billion plant there. That's all being, fed by the government and subsidized by the government. And you can argue whether that's good or bad in the long term, but in the short run, that's pumped up the economy. That's pumped up inflation, right? Reshoring and bringing jobs back to America, or even bringing them back to Mexico, which is what some things are happening, where some jobs are going that used to be in China. Then you're not going to get the inflation go lower. So he's mired into this. We got to be at 2% or close to 2% or on track to 2% in order to lower interest rates. And this is not happening, and I don't think it will. So if he does cut interest rates anyway and bows to all of the pressure, then the reality is his legacy is that he was a politician and not an economist. And he did what he did for political reasons, right? To serve the people in government, and to help them out in their election bids. And as a result, he's going to ruin his legacy, and he cares about his legacy. So I think that the reality is that he'll just he can't cut them right now because it's just going to be too transparent. And they're going to try to cook the books every which way they can, in my opinion, to get the number down there. But I just don't think it's going to happen. There's too much inflationary stuff going on in the rest of the economy to really allow him to do it, right? And thus he's stuck in this catch-22. But I mean, there's going to be a ton of pressure. But the real problem is that the thing that might actually drop the inflation rate down is when things in the economy break. If the banking system collapses because commercial real estate is collapsing. And if banks start going down, but then again, if they start bailing out the banks, it's back to put the inflationary pressure on there. And I do think that something, not right now, but a couple of years from now, may break in the residential market, because where they are right now, and that's going to be regional, but what prices, it's never been as unaffordable to convert from a renter to a buyer as it's ever been in the history of this country, ever been. So we're in uncharted grounds there.
So does that mean higher for longer is real?
I think they don't want it to be, and I think that they were always saying higher is longer for political purposes. That like if they said it was higher for longer, that would the emotion and the investor sentiment would then help push inflation down because it's kind of like if you believe it, it will come, right? And so if you believe the economy is worsening, then you stop spending, right? But they're pumping out so much debt at the federal level. And then the other thing is just that, the consumer is still spending, right? The most recent survey they did on summer spending showed that people are having these elaborate summer plans. And about a third of them don't even know how they're going to pay for it. They're going to put it on a credit card and wait for it later. Like, that's not good. If you're going to go spend $5,000 on a summer vacation and put it on a credit card at 25%, the fact, if you don't already have the savings there, how does that work, right? So they're going to have to suppress other spending, or they're just going to end up in one of these death spirals that unfortunately catches so many people out there when their spending gets ahead and they just make bad decisions.
Okay, so hold on a sec. Don't rates have to go down if the Fed cuts?
Well, even if they do cut, rates don't necessarily go down. Okay, that's people just think that they have a total control there. Look at it. They haven't done anything with interest rates for the last couple months, right? Where have mortgage rates gone? Mortgage rates are going back up. People are saying mortgage rates are going to be above 8% in the not too distant future, right? Now, I don't know whether that's accurate or not, but why? Because there's more going on there, right? If people see a lot of risk, then they're going to want more return, right? So if you're a mortgage lender and you're originating mortgage loans and you've got to go sell off these loans in the secondary market, like the market's going to demand something out of it, right? And you can't just take all of that on lower profit to yourself. At some point, you have to have a higher rate. So that's the market is driving the interest rates higher because of an expectation of inflation and an expectation that they're not going to be able to cut rates. So, but the other thing that can happen and is very likely, and I don't want to go into a dissertation on how the treasury market works and how they do these auctions, but the super simple thing is that, like, if not enough people are buying treasury bonds, then what they have to do to get more people to buy them is give them a better deal, a higher interest rate, right? That's why there's been so much focus with Yellen going to foreign countries and pretty much trying to get them to buy our treasuries and continue to buy them. And she's actually been pretty successful. The auctions have gone okay, but they go okay until they don't, right? And then if they've got to put, a couple $100 billion and they're having trouble selling, a 5-year at, 4%, then they're gonna have to sell it at 4.5%, right? That's the reality. They're gonna have to meet demand. And, they're also a lot of times right now, what they've been doing is they've been selling the shorter term end and not longer term bond because people don't want to buy longer term. And as a result, that means they've got to roll that debt over quicker and quicker. So, they're, at some point they call them the bond vigilantes, was the term from when I was younger and started in this business. But if the people buying the bonds aren't willing to buy them at a lower rate, you have to sell them at a higher rate. So the Fed could cut rates, but you could see the interest rates that people, on the mortgages, on the government, all of that stay higher, go higher, and that's going to drive interest rates across the market higher. So it's actually the government treasury rate that they get that is more important than what the Fed does. I mean, the Fed does have a lot of influence there, but if they wait too long and are having difficulties, or even if they cut it and inflation is still hot, they just bite the bullet and do that, and Powell decides that that's the best way to go. Nah, that's not a good result. Things aren't going to be good there. So just because they cut them doesn't mean that's what's going to happen.
So what does that mean then for investors?
Like I was saying before, you don't want to fight the Fed, but if you don't know what direction the Fed's going, it's pretty tough to be along, all that range. One thing that we're seeing people actually talk about now is no interest rate cuts this year. And we're talking about people saying that the next move is going to have to be, they're going to have to raise interest rates because inflation is going to be stubbornly high, right? And there's, I think, a lot of merit to that. And I tell you, they're cooking the books and manipulating numbers. Like, you look at unemployment, and the unemployment numbers are scarily consistent over time. And like, how do you keep numbers that consistent, with, new unemployment claims when you've got 50 states with 50 different systems? And, just the way the books are done on different states and different reporting should cause a bigger change than we're seeing. So, but I think a lot of people are lacking trust in the numbers. So, where does that leave investors? Well, I think that, they've got to be focused on like, okay, if I don't know which way interest rates are going, I can't count on them going up. I can't count on them going down. And maybe what happens is they stay at the same rate is they need to have an investment strategy that is not built on economic growth, that is not built on, a lowering of interest rates or a stimulus. But I do think that you want to do things to lock in returns at the current higher interest rate where they are now, right? And where does this bring this back to? What you and I talk about all the time: endowment model, right? Alternative investments, things that are not in the liquid stock, bond, commodity markets. Like, I do think there's a lot of good places to make money there in that area in this environment, but they're not the normal places. But, the alternative investments are where, you have to go. I think it's unfair that guys have to try to compete against me, to be honest with you, without these tools without these arrows in the quiver, without these tools in the tool chest of going to things that are outside of the stock and bond market where, you can get a good return and de-risk. But that said, that area, and I've said this before on this podcast, this economic environment makes alternative investments tougher too. There's a lot less that work. There's a lot of strategies that were great 5 years ago I won't use right now. So, it's harder work to find what's going to work in this environment as well.
But you can go to the bank or a money market and actually get paid a return on your money there. Why not do that?
Well, I mean, I think that's what I go back to. That's the savers, right? And I think that they've definitely been helped out by the higher interest rates now. But, if let's just say you're getting 4 or 5% on your CD, but you're paying taxes on it, that drops it down, and inflation's running, you could fight a debate or fight over what inflation counts and all that too. But, that only lasts so long, right? You just can't live off of a middle or low single digit return unless you've got a lot of money. And we all know that in the middle class here, a good middle class person may go into retirement with their house paid off and $1 million in a 401k. But if they're just going to earn 4 or 5% off that and then spend that and not reinvest any of it for their future, like, eventually their costs go up and then they blow through the assets. And it's not really their own fault. It's just that there's not a lot of financial acumen to understand that, the spending patterns when you go into retirement, and what your costs and needs may be down the line, right? So yeah, it's a short-term help to help people, but higher interest rates and turning yourself into a saver rather than investor, that strategy only works if you're worth, you've got a pretty high net worth to live off of. And the reality is that's just a very small percentage of Americans that have, let's say, $3 or $4 million of assets going into retirement and can afford to go into saver mode.
So other than curling up, and sometimes when we feel bad about ourselves, we like to do this, curling up in the fetal position, Larry, what should people be doing?
Well, so fortunes are made when economies are bad, better than when economies are good, right? So they've got to, I think one thing people got to do is not repeat and do what they've done in the past, right? Because here's the story. The stock market has been very good over long periods of time, but it does have significant periods of times where it makes no money. 72 to 82, stock market made no money. The 2000s, which is in everybody's lifetime here, basically the stock market overall made no money. So you can't passively invest and hope it works out. So I think you've got to be more targeted in what you do for investments. But I do think there's a number of things that are actually benefiting pretty substantially from the higher interest rates, where there's things you can do to lock in a higher return now, without a ton of risk. Everything has some sort of risk in it, and that will get you to the other side. But you've got to have you got to be forward thinking. I'm a big believer in the endowment strategy that we use. I think that is going to help, because if you can have some pieces there that are cash flowing just at a high single digit rate of return, right, that helps a lot, right? And then we've just got to understand that This is not a normal economic period. The 70s may be akin to this to a certain degree. And those of us, like I was a little kid then, but I still remember how difficult it was. But, we're going into the 1970s in a lot of ways, but with a lot higher debt globally, right? The federal debt, household debt, every way you sliced it, it's a lot higher now than it was in the 1970s. So, okay, how do you go through that time frame, but with all of these other costs, because everything is saddled with debt, right? Kids' college, cars, homes. I mean, people have more money than they ever had before, but they also have more debt than they ever had before. And the disparity of decisions you make now is going to have a big deal, but there's no book to read that's going to solve this problem for you.
That's why they come here, another home run right here on the Financial Architects podcast. Brilliant stuff, Larry. Larry likes to go to baseball games. So, coming here on the podcast and hitting a home run should mean a lot. So,
and more importantly, my son got a hit in the last 3 games of his season that ended yesterday. So obviously, my son's high school baseball is a big deal for me right now, and that end. So, but baseball is a good analogy. You gotta play 9 innings.
Got to play all 9. So for Chief Investment Officer and partner Larry Steinberg of Financial Architects, I am Evan Makovsky. Thanks for listening to the Financial Architects podcast, and we will see you on the next episode.